While financial accounting is all about the accrual method, which means revenue is recorded when it is earned and realizable and expenses are recorded when they are incurred, the missing piece of the puzzle is cash changing hands. For the users of the financial statements to get a total picture of the health of the business, cash payments and receipts have to be reconciled with accrual transactions. You accomplish this reconciliation by preparing a statement of cash flows. In this course, getting started with a statement of cash flows, you find out about the 3 sections of the statement of cash flows: operating, investing, and financing, and what types of accounting information are reported in each. To shake things up a little bit, there are currently 2 acceptable ways to prepare the statement of cash flows: using the direct method and the indirect method. The Financial Accounting Standards Board (FASB) prefers the direct method because it believes this method provides the user with more standardized info so companies can more accurately be compared. However, most companies use the indirect method because compiling the information is less expensive than when using the direct method. Before you finish the course, you find out how the statement of cash flows is prepared using both methods, so you are ready for any homework assignments or text questions on this subject in your financial accounting class. Financial accounting is all about the accrual method of accounting. With the accrual method, you record revenue when it's earned regardless of whether money changes hands. Plus, you record expenses when you incur them regardless of whether they are paid. Because recognizing accounting transactions for financial accounting doesn't hinge on cash being exchanged, there most likely will always be a difference between a company's cash balances and profits shown on the income statement. That's because all costs aren't expenses, and until a cost is an expense, it doesn't hit the income statement. In this section, we first show you how non-cash transactions influence a company's net income. Then we illustrate the difference between costs and expenses. Number 1. Profit. The statement of cash flows homes in on the difference between cash a company receives and profit it has earned. Profit shows the real net income for the financial period, factoring in revenue earned but not yet collected from customers and expenses incurred but not yet paid, rather than reflecting only transactions involving cash. Number 2. Expenses. Generally accepted accounting principles pretty much dictate the accrual method for financial accounting. There are some variations on this theme. However, your number 1 focus for your financial accounting class, when talking about costs and expenses, is to remember that in the world of business, costs are not the same as expenses. Make sure you don't get confused about the difference between costs and expenses. A cost is the value of money the company uses to produce or buy something, money that is not available to use anymore. Costs are the ways a company uses cash, be it to purchase inventory, make investments, or pay back a debt. Expenses are costs that directly tie back to revenue the company earns during a financial period. The primary purpose of the statement of cash flows is to show a company's cash sources and uses during the financial period. While cash can come from many different origins, such as customer payments, loans, and sales of assets and equity, uses of cash directly trace back to costs. This information is very interesting to the external users of the company's financial statements who are not privy to the day-to-day operations of the business because it provides a basis for understanding how wisely a company manages its cash. A company can be a real go-getter in the business world, but if cash is thrown around like chewing gum, the business may not be able to give the external users what they are looking for, which is basically a return on their investment. This holds true both for potential investors looking for dividend payments and potential lenders wanting to make sure the company can pay back the principal portion of any loan, plus any interest the lender charges. The statement of cash flows provides guidance for the following questions. Number 1. Does the company have the ability to generate positive cash flow in the future? You don't want to invest in a one-hit wonder. Viewing a current statement of cash flows does give a hint as to the company's future prospects. Number 2. Does the company have enough cash to make loans or dividend payments? Obviously, if you are a potential investor or lender for a corporation, it's probably not your idea of a good time to let the business use your money for free. You want to check out the statement of cash flows to see how the business manages its money and gauge the probability of the company having enough cash to satisfy its obligations and pay dividends. Number 3. Is the reason for the difference between net income and cash transactions indicative of a healthy business? All cash is not created equal. Cash a company brings in from gross receipts is a lot more exciting to me as a potential investor than cash the company has left over because it sold some assets. After all, the business can own only a finite number of assets, while with a well-run business, the sky's the limit for bringing in revenue from operations. You ferret out this information by reviewing the different sections of the statement of cash flows. Each section ties back to how accounting transactions affect the income statement and balance sheet. So you're not looking at new information, instead, you're looking at the same information shown in a different way. The statement of cash flows has 3 sections: operating, investing, and financing. Number 1. The sources and uses of cash in the operating section come from revenue, expenses, cash received from gains and losses shown on the income statement, and cash paid out for other costs. Number 2. The investing section shows sources and uses of cash from debt and equity investment purchases and sales of property, plant, and equipment, and collection of principals on debt. Number 3. The financing section shows long-term liability, paying or securing loans beyond a period of 12 months from the balance sheet date, and equity items, the sale of company stock and payment of dividends. Some of these terms may be unfamiliar to you. Don't worry, by the time you finish watching the rest of this section, you'll be in pro on cash flow. First, we satisfy your curiosity about the operating section. Here are examples of operating sources of cash. Number 1. Cash receipts from the sale of goods or services. This source is the cash that customers pay the company at the point of contact, or what the company collects at a later date from existing accounts receivable. Number 2. Trading portfolio sales, trading securities or assets business purchases to make a profit in the short term. How this normally happens is that a business has some spare cash lying around that it doesn't need access to in the immediate future. Rather than leaving the cash in the bank earning little or no interest, the company buys highly liquid, easily convertible to cash, stocks, bonds, or loans. Number 3. Interest and dividends. If the company makes loans to other businesses or individuals, any interest income it receives on those loans goes in the operating section. An example is a loan to a shareholder who is also an employee and needs cash beyond what she's receiving in her paycheck. This situation happens often in a closely held corporation. Here are the operating cash outflows you'll see in your financial accounting textbook. Number 1. Satisfying accounts payable. Accounts payable is the amount a company owes vendors for services and products the vendors render to the company. When the original purchase takes place, no money changes hands between the customer and the supplier. Rather, there is a promise to pay within a certain amount of time. Number 2. Trading portfolio purchases. Just as sales of trading securities are a cash source, the amount of money the company pays to buy any trading security is a use of cash. No securities other than trading securities go in the operating section of the statement of cash flows. Again, the key here for operating section placement is that the investment is short-term. Number 3. Payments for other business expenses. This category includes any cash outlays to buy inventory, pay employees, remit income taxes due, or pay any other suppliers, such as utility providers or the telephone company. Number 4. Interest payments. Any cash paid to lenders in the form of interest also goes in the operating section. It doesn't make any difference what the purpose of the loan or source of the loan is. So, interest paid to a related party, such as a shareholder, for an operating capital loan, cash made available for day-to-day business functions, is treated in the same fashion as the interest paid to a vehicle financing company for the note on the company car. Here, we show you specifically how investing transactions show up as sources of cash. Number 1. Long-term debt sales and collection. A company's investments in debt may fall into 3 categories: straight-out loans, held-to-maturity debt investments, and available-for-sale debt portfolios. Number 2. Sales of equity investments. If the company sells the stock it owns in other corporations, the cash it receives is an investment source. Number 3. Sales of property, plant, and equipment and intangibles. The cash proceeds from any PP&E the corporation owns and sells, such as cars, buildings, or equipment, is an investment source of cash. Ditto if the company sells an intangible such as a patent. A patent provides licensing for inventions or other unique processes and designs, thus limiting who can profit from them. Here are the potential uses of cash that would appear in the investing section of the statement of cash flows. Number 1. Loans and debt purchases. Any cash the company loans to another company is a cash outlay. So is any cash the company uses to buy bonds. Number 2. Purchase of equity investments. This category includes any cash the company uses to buy stock in another corporation. Number 3. Purchase of PP&E. If the business pays cash for any fixed asset acquisition or an intangible asset, this outlay of cash must appear in the investing section. Financing activities are the flip side of investing, so if you have a handle on investing, you'll be able to whiz through financing activities. Financing activities show transactions with lenders such as with long-term liabilities, paying or securing loans beyond a period of 12 months from the balance sheet date, and equity items, the sale of company stock and payment of dividends. Both short-term and long-term debt the company becomes liable forgo in the financing section. How long the creditor plans to hold the debt determines whether it goes on the creditor's books as short or long-term debt. Here are the uses of cash that would appear in the financing section of the statement of cash flows. Number 1. Treasury stock transactions. Treasury stock is shares of corporate stock that were previously sold and have since been bought back by the issuing corporation. The use of cash is to buy back stock from shareholders. Number 2. Cash dividend payments. Cash dividends are earnings paid to shareholders based on the number of shares they own. Dividends can also come in the form of stock dividends, which don't involve cash changing hands. So, remember, only cash dividends go in the financing section. Number 3. Paying back debt. Any principal payment a company makes on bonds or loans is a financing activity. Principal payments on capital lease obligations are financing activities as well. There are two ways to prepare a statement of cash flows: the indirect and direct methods. The Financial Accounting Standards Board prefers the direct method, while the business community prefers the indirect method. Regardless of which method you use, the bottom line cash balance is the same, and it has to equal how much cash you show on the balance sheet. In this section, we show you how to prepare a statement of cash flows using both the direct and indirect methods. So, no matter what happens, you need to have a handle on how to use both methods. First, using the direct method of preparing the statement of cash flows shows the net cash from operating activities, so it shows all operating cash receipts and payments. Some examples of cash receipts you use for the direct method are cash collected from customers, interest, and dividends the company receives, and other operating cash receipts, such as cash received if the company sells an asset. Examples of cash payments are cash paid to employees and other suppliers, and interest paid on notes payable, capital leases, or other loans. Here are 3 key facts to remember about the direct method. Number 1. Your present cash received and paid, not net income or loss as shown on the income statement. Number 2. Any differences reflecting when using the direct versus the indirect method take place only in the operating section of the statement of cash flows. The financing and investing sections are the same, regardless of which method you use. Number 3. The FASB prefers the direct method because it believes the direct method gives the users of the financial statements a more complete picture of the health of the business. Second, using the indirect method. When you use the indirect method of preparing the statement of cash flows, the operating section starts with net income from the income statement. You then adjust net income for any non-cash items hitting the income statement. Your 2 biggies are depreciation and amortization expense, both of which are non-cash transactions. Other common items requiring adjustment are gains and losses from the sale of assets. This is because the gain or losses shown on the income statement for the sale will rarely if ever equal the cash a company receives. In other words, gain or loss is based on the difference between the asset's net book value, which is cost less accumulated depreciation, and the amount the item sold for, not how much cash the buyer hands over to the seller. Users of the statement of cash flows are primarily interested in whether the company has positive cash flows from operations. As a general rule, a company should be covering its costs by cash it brings in from the day-to-day running of the business rather than from borrowed funds. As a potential investor or creditor, we want to see that cash the company brings in through operations exceeds any cash brought in by selling assets or borrowing money. This is because selling assets or borrowing money can never be construed as a continuing event like bringing in cash from selling goods or services. A company may issue stock or bonds in order to expand. The amount it generates may well exceed the net cash from operations. On a non-recurring basis, that situation can be okay because successful expansion is a good thing for investors and creditors. However, unless cash from operations with regularity exceeds cash from other sources, a company will be paying back debt with debt, which is decidedly not a good thing. Here's how an investor and lender use the statement of cash flows. Number 1. Investor. An investor wants to make sure the corporation has enough cash flow to pay an adequate return on investment. In other words, can the investor anticipate getting a cash dividend each year? Also important is using the statement of cash flows to evaluate how well the company is managing its cash, because investors will eventually sell their shares of stock, something that won't be possible if the company mismanages its cash to such a point that it goes out of business. Number 2, creditor. The creditor also has a vested interest in making sure the company has sound cash management. After all, in addition to the interest income the debtor pays for the use of the loan, the creditor wants to make sure it also gets paid back the principal portion of the loan. It's never a good sign if a business is paying back debt by assuming more debt.